Hello, Politics Plus Media 101 listeners. Before we begin today's program, we'd like to briefly explain why we haven't had a program in the last week, and that's because our fearless leader and my co-host, Justin Higgins, came down with COVID, which kept us out of the game for just a few days. But today we are back, and we're here with a conversation on one of the major stories in the U.S. economy, the apparent crisis that we're facing in the banking sector. And the guest that we have for you is Aaron Klein. He is a senior fellow in economic studies at the Brookings Institution, and he's also a veteran of the U.S. government in the Treasury Department. And he played a role in crafting policy right as we were recovering from the global financial crisis from 2009 until 2012. So we're very glad to have Aaron on to walk us through an extraordinary time in the U.S. banking sector.
It's a pleasure to be on. Thank you for having me.
So, Aaron, let's start with the big question here, especially if you're a person that's interested in politics, you're trying to understand what's going on in our banking system. Somebody like myself, I turn on CNBC or a political network, and it's oscillating between SVB and Signature Bank's failures being the canary in the coal mine, or just an isolated incident that isn't representative of a larger risk of system-wide contagion. Can you help us understand where we are at right now in our banking system after the failures of those two banks?
Sure. A couple of things people should know to level set. America has just under 5,000 banks. We have 5,000 banks not because that's the economically optimal number to have today, but because we used to have 16,000 banks as recently as the 1980s. And why do we have 16,000 banks? Well, banks couldn't really operate in multiple states. There were legal prohibitions against multi-state branching and banking that were not removed until the mid-1990s. There's been massive consolidation in the banking industry, both pre and before that situation. But fundamentally, we have an interesting system that, like all banking systems, at its core has to have trust. You have to have trust that your money is in the bank. No bank, no matter how well regulated or how well managed, can withstand all of its deposits fleeing at once. Now, the current situation with Silicon Valley Bank, SVB, and Signature Bank, and a smaller bank that failed before it, Silvergate, but was not bailed out, whereas those two were. Those two banks failed for slightly different reasons and started a bit of a fear of contagion in the broader system. And the financial regulators activated systemic risk authority that they had been given in order to try to stem the broader fear. People should appreciate that banks fail. Do you guys want to guess the first year in American history where not a single bank failed?
Was it during the COVID pandemic, like 2 years ago, maybe?
So you are right that no bank failed in 2021, but there was a time that every year in American history, a bank failed until 2005. And 2005 was the first year in American history that not a single bank failed. 2006 was the second. And financial regulators came before Congress. I was the chief economist at the Senate Banking Committee at the time. And they said, we're doing a great job. The system has never been safer. As evidence, not a single bank is failing. And now we obviously know, with the benefit of hindsight, that the system could not have been more screwed up than the first 2 years where we don't have a failure. See, the lack of failure is actually a bigger problem. Now, John, you were prescient in guessing that the next time we'd go 2 years without a bank failure was 21 and 22. However, I should reassure folks, I lived through the subprime crisis in 2008, and those toxic mortgages and their affiliated securities have permeated every pore of the financial system through banks and non-banks and others. Silvergate and Signature banks failed. They had big business in crypto. That was one of their few customers, two of the few banks that were deep in crypto. Silicon Valley Bank was not a bank for people. It was a bank for tech firms and a few of their executives. To give you an example, often people talk about banks by size. Silicon Valley Bank was a $200 billion bank. That sounds really big, right? It was America's 16th largest bank. That sounds really big. Well, there are other banks about that size. They're called regional banks that bank people. Fifth Third, Huntington's, those types of M&T. For those of us on the East Coast, I'm a proud Marylander. They were a Maryland bank before they merged with a New York bank. Those banks have about 1,000 branches for a $200 billion bank. Silicon Valley Bank had 16 branches. Another bank of its same size that may or may not go under, that's the current subject of speculation, First Republic, has 72 branches. These are not banks that branch people. They're banks that branch businesses. businesses can behave very differently, right? Silicon Valley Bank's 10 largest customers had $13 billion in deposits. Do you know how many ordinary Americans it would take to get $13 billion in deposit? Right? These 10 corporate treasurers, if they withdrew, would have withdrawn $13 billion in aggregate. Very, very different business model. So the problems that we've seen in these banks, I'm not saying they're unique. There's a story that came out that looked at 90 other, mostly small banks that may have had different problems in some of the problems, and we'll get into the specific problems that caused Silicon Valley Bank's failure. But this is not a systemic incident the way that the subprime mortgage crisis was.
So, Aaron, you talked about the extraordinary number of banks that we have in the country. And before we get into the reasons why Silicon Valley Bank failed, it's interesting to note how much of the tech industry were using Silicon Valley Bank. So why was there so much concentration of that industry in this one particular bank? And do you think that that sets up a risky situation where so much is riding on this one institution?
So, John, a couple things on that. I think it was pretty odd, and I'm looking forward to more facts and analysis. The Federal Reserve regulated Silicon Valley Bank from head to toe and was completely asleep at the switch and missed simple classic red flags that were problems with their bank. But they still haven't discussed problems within the bank holding company. So can I get just a little dorky for a second on banking in America?
You have 1 second to get dorky. I'm starting the stopwatch.
All right. So stop me when I get dorky. But America separates banking and commerce. Much of the rest of the world doesn't do that. So, John, just when I say Mitsubishi, what do you think?
A lot of things, isn't it? It's like cars, pens. It's all sorts of things, isn't it?
It is one of the 10 largest banks in the world that happens to have a small car company.
Jesus.
Right? Most people, I do this lecture all the time, Mitsubishi, nobody says bank. They're a giant bank. In America, you can't be a bank and a car company. We separate banking and commerce. And the way that we do that is we have a thing called a bank holding company. And all banks have to have a holding company that's called a bank holding company. All bank holding companies are regulated by the Federal Reserve, and then some banks are regulated by different players. Silicon Valley happened to also be regulated by the Federal Reserve. So Bank of America, Merrill Lynch, for example, the old Merrill Lynch stock thing is an investment bank that has a different structure than Bank of America, which is a commercial bank, but they have the same holding company. So I go through all this because Silicon Valley Bank had a venture capital holding affiliate within the holding company. We don't know exactly what the rules were when they invested in you, whether you then had to go to Silicon Valley Bank as a customer. Well, we do know that Silicon Valley Bank did lots of lending to executives at tech companies who might not be very liquid. So there's a classic story of the founder, company gets really big. They just did a C series of funding and they're valued at $1 billion and the guy owns 40% of them. So on paper, he's worth $400 million, but he can't sell a stock. They're not publicly traded. How does he buy a fancy house? How does he get his fancy car? How does he pay his taxes? He needs to have a loan against that collateral. A lot of banks that used to do that stopped doing that when they got burned in the dot-com bubble. Silicon Valley Bank didn't. They leaned into that business. Now, if you're the corporate treasurer and Silicon Valley Bank has helped you out with a nice loan against these illiquid assets that you have, what's going to happen when you go to say, maybe I should change my account, maybe I should diversify, etc. So we're not entirely sure why all of that was. We do know it was rapid, right? They quadrupled in size in 5 years. So they were under $50 billion in 2018, and then they were over $200 billion by 2022. And that rapid alarm bell was one of the 4 classic red flags. It was kind of like all that together should have been a red laser beam screaming for greater regulation and supervision by the Federal Reserve. But that, I think, answers your question, John, of why were there so many tech firms there? And the final point I'll make about that is under the law, as modified, there's original Dodd-Frank that after the financial crisis, the Republicans rolled it back a bit. And under the law as modified, the Federal Reserve had the optional authority to apply enhanced regulatory standards if they deemed a bank systemically important between $100 and $250 billion, the size of Silicon Valley Bank. The Federal Reserve chose not to apply those tougher standards, thus saying they aren't systemically risky. Then when it came time for them to fail, they panicked and hit the bailout button and said they were systemically risky. So either the Fed was wrong in not applying the tougher regulation because they were, or they were right and shouldn't have panicked and hit the bailout button and should have let them fail and not bail them out. We'll never know the answer to the latter. If we believe they were right to bail them out, then they were classically wrong in assessing their own systemic risk, which is ironic because you have no idea the amount of money, bureaucracy, and person hours the Federal Reserve has spent thinking about systemic risk over 15 years. And yet here they blew it in one of the first, most simple cases right in front of them.
Aaron, I guess we're kind of tiptoeing into the causes behind the collapse of SVB. And it's interesting you mentioned the Federal Reserve because it feels lately like no matter what problem we're noticing in the economy, fingers get pointed at the rising interest rates. It's the explanation behind almost everything that's being observed right now, not even just in the United States, but around the world. And I'm wondering if you could give us an assessment of to what degree you think that increases in interest rates by the Federal Reserve might have impacted the situation with SVB. Do you think that, it can be used as an explanatory factor in this situation?
John, there are two different answers to your question, and they're both very important. The first is the confluence of monetary policy and this bank's failure. The reason Silicon Valley Bank failed, or a main reason, was it took this huge influx of money that we discussed as their deposits quadrupled, and they bought what were very safe assets, treasury bonds, and mostly Fannie and Freddie mortgage securities. Put a different way, you guys remember when you could get a mortgage for 3.5% and 4% way back when, 2 or 3 years ago?
Yep.
Well, somebody bought all those mortgages, and that happened to be Silicon Valley Bank. They didn't make the mortgage, right? That's what like your regional and local bank actually does. They just bought them when they went through the government guaranteed securitizations in the secondary market. And then they said, look, these are safe assets. But what is the value of a mortgage at 4% when interest rates rise? When interest rates rise, the value of that asset falls. And so while the asset was safe from a credit risk standpoint, it wasn't going to default, it had interest rate risk, which meant it lost money. It lost value. For a while, they hid it in accounting, but it was pretty plainly obvious. It was disclosed in quarterly reports that the losses were disclosed publicly. The regulators saw the losses. They were hiding in plain sight. And so when you say, did interest rates cause the thing? I mean, in one sense, in a very literal sense, yes, they made a speculative bet. In a structural sense, not at all, right? Any person hedges their rate risk, right? That's what you do if you want to run a safe and sound bank. You buy these things and then you pay a little money to hedge the risk. So if interest rates go up, you're protected. And if they stay low, you lost the money in the hedge. Silicon Valley Bank didn't hedge. Their stock price tripled from 2020 to 2021. They're beating the estimates. Why? They're not spending money on this costly hedge. Because remember, interest rates shot down in 2020 during COVID and stayed low longer than most people thought. But again, you got to hedge your risk. They didn't hedge their risk. And the Fed said, fine. So I think it's a bit of a canard to say, well, the problem was the monetary policy caused the bank failure. No, what caused the bank failure was mismanagement of their own risk and sloppy regulation not to put the alarm bells on their mismanagement. Compounding that all, which is infuriating, is then the taxpayer bailout on top of the sloppy management and the poor regulation. The other question behind it, which is a little deeper, is what's the role of the Federal Reserve? Well, the primary role of the Federal Reserve is monetary policy. Any organization, doesn't matter if you're the central bank, if you're a business, if you're a government, whatever you are, if you're a podcaster, you can only have one telos, one number one priority, one North Star. And for America's central bank, that is and always will be monetary policy. That's how it should be. So then the question becomes, what does it mean when bank regulation is structurally second tier? What does it mean when these issues are never the top issue of the organization? Does that mean it's the right place for that organization to have those responsibilities? That's the conversation we need to be having in America, not the question of, well, the rise in interest rates to combat inflation was the proximate cause, right? That, I think, misses the key issues and gets lost in weeds that aren't really connected to the root cause.
So just to follow up on something you said a little bit earlier, Aaron, I think the stat was the top 10 investors of Silicon Valley Bank had $13 billion worth of deposits. And we saw during this, whole kerfuffle or crisis or whatever we want to call it, that there were reports that folks like Peter Thiel, who had a ton of investors using SVB Bank, a ton of companies, for example, because he's partly a VC, basically instructed these folks to withdraw their money. Same with folks like David Sachs instructed their clients to withdraw their money before all of these issues kind of compounded into the crisis. Was the actions of these specific investors key to the bank run that we ultimately saw?
So I'll say the following points, right? One is there's been a bit of a misnomer or attempt to blame this as a social media, right? This was a Twitter bank run. In fact, the Federal Reserve's testimony that's coming to before Congress tomorrow, which was just released today, mentioned social media twice. And that's a canard in the sense that Silicon Valley Bank wasn't a bank for people. It wasn't people on Twitter seeing other tweets getting nervous. It wasn't the Facebook posts that your parents or grandparents post around that kind of, may or may not be hinged in reality, right? To the extent this was posts on LinkedIn and emails sent by sophisticated VC folk realizing the problem at the bank, which had been hiding in plain sight for quite a while, and having the bank having their customers. And this is why, and the FDIC chairman's testimony zeroes in on this, having a concentration of large uninsured depositors makes a bank riskier. Depending on what moment in time, Silicon Valley Bank had 88 to 97% of their deposits uninsured, above $250,000 at these large folks. Signature Bank in New York also had a classic concentration of uninsured deposits. It's one reason why I'm more sanguine about your Main Street regional or community bank, right? Those have deposits from actual people. So that absolutely made them more risky. What is infuriating is then Peter Thiel got bailed out, right? He says he had $50 million of his own money left at the bank. Who knows what he had before he started pulling out? He should have been the one suffering losses on this. Instead, the three of us are going to pay more in bank fees. And it may not be us. It may be lower income people in higher account minimums or other things, right? We have a basic banking system in America that's a giant reverse Robin Hood, right? Free checking if you have more than $1,000. But if you're the half of Americans who live paycheck to paycheck, you get charged $10 a month in a minimum balance fee and $35 for overdraft. I am infuriated that the bank regulators bailed out Peter Thiel's uninsured deposits, but did nothing to suspend overdrafts for all the people who had their paycheck that didn't come through on that Friday when that bank failed, or the 15th of March, the following Tuesday. Lots of paychecks got messed up because of this. There was no suspension of overdraft. There was no guidance to the banks to waive fees on lower income people, right? On people living paycheck to paycheck trying to get by. Oh, but if Peter Thiel loses money, we're going to have systemic risk. So we have to bail out him and Roku. Roku had about a little less than $500 million. They're one of the bigger depositors that I've seen. So what would have happened if Roku had lost a little bit of their money? I think they would have made payroll. I think we all would have had streaming services, right? But no, Roku has to get bailed out.
So we also hear another argument primarily driven by these folks, Bill Ackman being another one, these really sophisticated investors. David Sachs has done it on Twitter. A lot of folks have. And it sounds like to me that they're trying to place blame on the Biden administration and the Fed by decrying the rise in interest rates.
This is an arsonist pouring gasoline on other people's houses, throwing away his cigarette, and then blaming the gas station for selling the gas in the cigarette. This isn't a sensible counter argument to have in this situation. There are lots of folks to blame. We can talk about how much the Trump era deregulation played into this or not, right? We can talk about the Federal Reserve rightfully should get blamed heavily for their job as a bank regulator and supervisor, right? Those are all legitimate criticisms here. But essentially, every wealthy person wants to have a guaranteed bet. If the bet goes out well, they make money. And if they lose money, the government bails them out. I mean, would you guys like that?
I'd love that.
Yeah, well, that's what they got. And that's what they got under Trump in COVID with the money market mutual fund bailout. That's what we're getting with this uninsured deposit bailout. They're talking their book and they're getting paid.
Yeah, and we will get into the deregulation or the Trump administration. And just want to highlight, we are as infuriated as you are about the arsonists in the match and really trying to cover their own asses, pardon my language here, because to somebody who's not financially literate like yourself, it feels like every time there's mistakes made by the ultra wealthy, it's trickle down economics, right? Where those of us on the bottom half or whatever of the spectrum have to pick up the tab. So it is very, very infuriating. I want to ask a follow up here because you see all of these folks, the ones that we named, we don't need to keep naming them, But they're also now saying that Janet Yellen needs to explicitly say that all deposits in all U.S. banks are backed by the U.S. taxpayer. Can you walk us through that? It seems like what you just said, that they're trying to eliminate risk, but it also feels really, really, really bad faith.
So let me say a few things, right? Franklin Roosevelt created deposit insurance as a way to stem the Great Depression and instill confidence in the banking system. But he predicated it that the government's role is to protect the little guy, the average American, the ordinary family, who shouldn't be at risk from the bank failing and frankly don't have the ability to look through the bank's quarterly call reports and government data and et cetera. And so from the beginning of deposit insurance, there's always been a cap. That cap has been raised periodically. I participated in the law that raised it the last time, which was actually the same law that created the TARP bailout from $100,000 to $250,000. And at $250,000, about 98% of Americans don't have that much money in the bank account. If you lined up 20 Americans, from the person who earns the least to the person who earns the most, and you took the 19th out of the 20th, the second richest guy in the room, and you said, how much is in your bank? It would be a little under 70,000, less than 3 times that. Whether the 20th person has it or not depends on your room. Decent chance they're under 252. So the idea was, if you have more than $250,000, you need to keep a little bit of an eye on your bank. And that's very important, because if you're not doing it, who is? If the market isn't keeping an eye, if the depositors aren't, the only people left keeping an eye on it are the regulators. And good Lord, do the regulators get it wrong, right? We've gone through the Federal Reserve getting it wrong on Silicon Valley Bank. We could talk about all the regulatory problems we had in the last banking crisis and the savings and loan crisis of the 80s. For those listeners who remember when there were things called savings and loans and thrifts, right? Regulators got it that wrong there too. So you have to have multiple sets of eyes here. And the problem is we've now created this difficult precedent. Economists struggle with 2 different concepts. One is called Pareto improving. That is, if there's a policy that makes one person better off and no one else worse off, Econ 101 says, well, that's a good deal because society at a whole is better off and no one's worse. There's another concept called horizontal inequity, which says, Justin, if you and John are identical, but I decide John should get a $10,000 gift because, you know what? I like him, or I flipped a coin, or we're going by alphabetical. You're no worse off, but you feel kind of upset. That's unequal. That creates, right? 2 people on identical things got treated unequally for no reason or fault of their own. A sophisticated economist will push back and go, actually, well, Justin's worse off because he's psychologically angry, right? And versa, that's a behavioral economist. A simple economist would just say, well, he's no worse off. John has money. When the government creates horizontal inequity, people get really ticked. And so having bailed out the uninsured depositors at these 2 banks that were mismanaged and skewed heavily towards the wealthy, imagine the outcry. And this came forward at a recent congressional hearing when Senator Langford of Oklahoma said, what if my little community bank in Oklahoma goes down? How are their uninsured depositors going to get treated? And Secretary Yellen had a little bit of a tougher time answering that because the legal authority for them to go over the 250 cap has to invoke the argument that the system is at risk. And so it's harder to make a systemic argument for smaller financial institutions. On the other hand, could you imagine the backlash if a random small bank, and random small banks fail generally, a couple a year, at least they should, in my opinion. And so, what would happen? What would be that situation? Imagine a small credit union that failed. We have actually more credit unions in America than banks. Should those people be treated unequally? So we're kind of at a very difficult position where we have legal requirements, and then you have political requirements, and then you have, kind of conceptual requirements. Keep in mind, we know a couple facts from the 2008 crisis. Bear Stearns was bailed out. That bailout did not stop a financial crisis from happening. Some people go, well, the bailouts suck, but they're better than having a crisis. Okay. But Bear was bailed out and we had a crisis. And 2, Lehman wasn't bailed out. And the reaction to Lehman not being bailed out was so much more severe because the expectation was, well, if you bailed out Bear, you bail out Lehman. And why would you bail out one and not the other? And that creates this horizontal inequity and this troubling situation that they find themselves in.
Aaron, was there a good explanation for why Bear got bailed out and Lehman didn't?
There are a lot of explanations for that. I'm not sure how many of them are good. What I will say, and this is, very simple. I went to Dartmouth College, which is a wonderful institution, a breeding ground for investment bankers, right? I was a long-haired hippie in the back of my econ class who had no interest in going to Wall Street and was excited to go to graduate school and public service, right? That stood out, right? Most of the people there were dying to go to the street. There was a pecking order of where you wanted jobs from, right? This is in the 90s, right? 1 was Goldman, 2 was Morgan, 3 was Merrill, 4 was Lehman, and 5 was Bear. And that was the classic 1 through 5 pecking order. It's fascinating that, more than a decade later, as I sat in a front row seat to the collapse of the investment banking world, the first one to go was Bear, then it was Lehman, then Merrill was on the tipping point and got a shotgun marriage to Bank of America in order to survive, and Morgan and Goldman survived kind of on their own, right? The exact reverse order of what college recruiting was like. And, there are lots of other explanations and theories. I just know that correlation is stunning and always stayed with me.
Wow, that's funny. It's also funny you mentioned Dartmouth because Justin and I are both New Hampshire. So all 3 of us on the panel today are New Hampshire people. Aaron, looking back to that period, one phrase that we heard a lot about the banks that got bailed out and the ones that didn't was this concept of too big to fail. It was, I think there was even a movie about what happened and it was titled Too Big to Fail. And it's funny you mentioned how well known those institutions were, the ones that got bailed out. And maybe there's some intuitive aspect to them being too big to fail in that regard. Silicon Valley Bank, I'd never heard of it until a month ago. Does this situation cause us to redefine what it means to be too big to fail? Is there any conclusion we can draw on that front?
There are. So too big to fail in the world of banking has become like a 4-digit hashtag, right? TBTF. But when you stop, it's actually 2 separate thoughts. One is, are banks and financial institutions too big, right? We periodically break things up because they're too big. Right? AT&T got broken up. Are there too few airlines, right? Are there, do things become too big? There are people that object to financial institutions simply on the basis of size, too big to manage, too big to be risky. There's a secondary question, which is to fail. Can we allow the failure of an institution without then creating a domino effect that ripples through this core element of trust? Remember, all banking is based on trust. And it's trust that creates the problem, right? Not necessarily, right, the other interconnectedness or this or that. It's the panic and the trust. We tried to solve too big to fail in Dodd-Frank by creating all sorts of tools to allow regulators to fail institutions regardless of size. Most of those tools were not used for Silicon Valley Bank. There was orderly liquidation authority. There was all these single point of entry. There were all these different tools available. At one level, regulators have to have the courage to fail an institution. You'll never know if there's a question about whether or not universities fail students anymore, right? Is school too easy to fail? And part of that is, do professors give Fs anymore? I have struggled with regulators who view their goal as not allowing failure on their watch. I think that's the biggest failure you can make. And so I think there's a bit of a mindset situation where you have to let people fail. Do you guys have kids?
No, not yet.
Well, at some point, I hope you do. It's the greatest one-way turn I've ever taken in life. And you're with your kids, and maybe your kids play sports, and your kids play, and they'll lose. And that's okay, right? Do you want your kid to win every game they ever play? No, they have to learn to lose. And so it's difficult. It's difficult. A regulator who views their job as having no banks failing on their watch is like a parent who wants to wrap their kids in bubble wrap and not let them take any chances. And so you have to do that. And you have to say, okay, look, you lose, you pick yourself back up again. The bank fails. Okay, we have tools. We're going to impose losses on that, but we're going to wall it off in this situation. And at that point, there becomes a judgment call. In the judgment of the regulators in the room, the failure of these 2 banks would set off a set of problems that was too great for them to contain despite all the additional authorities they were given. Maybe that means they weren't given enough additional authorities. Maybe it means they didn't use that well enough to begin with. Or maybe it means they made the wrong call and they should have let those institutions fail. In the guise of COVID relief, The Trump administration bailed out all sorts of people. The Federal Reserve bailed out junk bond holders. You'd lost a lot of money betting on a junk bond. Don't worry, the Fed will bail you out. Who could have seen COVID coming? Now, I remember a day when investors lost money. So, there ought to be a question of have we built a financial system where it's winners only? And what does that mean for, capitalism? Is that a capitalistic economy where the holders of wealth can never lose their money, even when they make bad bets and don't abide by the rules?
So, Aaron, let's get into a little bit of how that system has been built by folks like yourself on committee staff. Not only that, by regulators. And another area of causation could be seen as the revolving door issue, where you have folks like yourself, you have folks like members of Congress go and be employed by these banks and then use their leverage to go and lobby and create a system or a narrative that is exactly what you just said. We can't let anything fail. What I'm thinking about here is Barney Frank and Signature Bank sitting on the board. Is that just a political argument?
I don't buy that for a few different reasons, right? One is the stockholders of those banks were wiped out, right? So unlike other crises in the past in 2008, where the equity holders weren't wiped out, the holders were wiped out. I think there's some legitimate questions about governance and independence. I find it concerning that the CEO of Silicon Valley Bank sat on the board of the San Francisco Fed Reserve. So you have a banker sitting on the board of their regulator. That's not a revolving door, right? That's just a question of that set of influence. I think there's a philosophy, right? I think you have philosophical issues where one group of folk want more regulation, one want less. And then they go back and forth and there's a regulatory pendulum swing. But then there's also a question of who's going to allow the institution to fail. But I've not seen kind of compelling evidence to suggest what you're kind of applying is some sort of odd corruption where I'm not sure I see the economic incentives or alignment, right? The executives at Silicon Valley Bank lost some money. Now, some of them made some money. I found it disturbing that the CEO of Silicon Valley Bank was able to sell his stock, $3.7 million worth of his stock, just days before they collapsed. And this was approved by the Fed. But I'm not entirely sure that the revolving door explains that. I think the organizational structures may have some explanation, as well as the regulatory incompetence of the Federal Reserve in this case. But I've not seen kind of the evidence to show this. I think what you often see is a set of ad hominem kind of linkages that don't make much sense. I'll point out there was an interesting study, Justin, by some academics that looked over the history of the Securities and Exchange Commission. And they kind of divided the people that ran enforcement into two categories. Academics, who presumably had no revolving door conflict because they were just tenured going in and out, and kind of corporate people, white law partners, etc., right? Who presumably, represented these clients both prior to and potentially post their government service. You want to guess which of the two groups was more aggressive in their fines?
The corporate folks.
Yep. Now, one explanation was they were being more aggressive to show more value so they get paid more on the flip side. The other is they knew where the bodies were buried and they knew how much pain and the value of this. And that when they switched their hat into public service hat, they were able to push and pull harder on that. But I think people need to, before they think through the revolving door argument, they need to think more exactly about what all that means and what the analogies are. And if you really believe in that, one, show some evidence, and two, explain to me the alternative world, right, in which those folks get it. One of the reasons why I think the Federal Reserve has done nothing to make our payment system faster for a long time. You go to the rest of the world, they have real-time payments. America hasn't, right, for years. England did it when the first iPhone came out, right? We're not going to have it until maybe the iPhone 15. Well, the banks make tens of billions of dollars a year on overdraft, in large part because the money moves slowly. Now, how much overdraft do you think has been paid by government regulators who have good, not great paying jobs? Very little, right? One out of about 8% of Americans pay $300 or more a year in overdrafts that constitute 80% of the overdrafts. You think those 8% are PhD economists at the Fed or senior regulators at the OCC? No. And so what you end up with there is, I think, more, when we get very afraid about the revolving door, we also then say the question, well, the only people we can have are career people who've who've never worked in a bank, never worked an industry, never had a different set of life experiences. I'm very concerned about where that leads, and we can have a different conversation on groupthink.
Aaron, we're talking about the revolving door as one explanation for how political pressure, regulatory pressure might build. Another source is the media. We've seen in many areas of public policy how news media activity and focus can lead to legislative action, regulatory action, and so on. At the time that Silicon Valley Bank was collapsing, we saw many of the figures, someone like this gentleman, David Sachs, who were connected to the bank and had their investments at the bank, going out on television and calling aggressively for a bailout, causing alarm about the situation with the bank. I'd love to hear your perspective on whether this is responsible of those media organizations, in particular at a time when there's a bank run happening, to have a figure on there who is perhaps participating in that bank run and raising alarm and more panic.
Look, I'm not I don't fully understand. I'm an expert in bank regulation, how much media has a duty to maximize their profits and produce entertainment versus produce fact or news. Those are not questions that I'm well versed in. The Wall Street Journal had a front page story on the problems of Silicon Valley Bank in November, 5 months before the situation. I think it's very responsible for media to call into question bank balance sheets, particularly when regulators aren't sounding the alarm bell, right? And I think it's very appropriate for media to hold regulators accountable. I get nervous when access to government and regulators is traded in exchange for positive news coverage. But, in terms of what is or isn't responsible for media in these types of situations, I don't know. I somewhat struggle myself. I mean, I don't want to exacerbate the problems, right, in the banking system. It's irresponsible to yell fire in a crowded movie theater, right? But if you see a little bit of smoke in the corner, it's responsible to say, like, maybe you should stay away from that in a situation, right? Or you see a wire, say, yeah, don't trip on that. So, as a public commentator, there's definitely a bit of a tension and a nuance. And it's difficult as a public commentator, speaking for myself, when you talk to somebody in print media, for example, right? In our interview, we're going to have a long conversation. You can judge it all by this or that. But when you're doing a print interview or a soundbite for NPR or something, you can get taken out of context easily. And you could say, look, the system is stable, but there are real hidden losses in other banks. And if you only hear that second part of that clip, right, are you destabilizing the system or not? What I do think is people shouldn't, folks talking their book. I like to say everybody's against a bailout except people in a leaky ship. And so, I do think it's incumbent upon all media to ask people hard questions and to ask people, are you talking your book? Are you using this platform for self-enrichment?
Aaron, that Wall Street Journal article that you mentioned that came 5 months before the collapse, were they pretty much dead on in their assessment?
They had a lot of things right. They flagged a lot of the problems, and a lot of these corporate treasurers just paid no attention. Look, one thing I want to point out to the listeners, and we've kind of danced around this in different ways, is corporate America and investors want to be able to have super safe assets where they don't have to do due diligence, but they don't like how much government debt yields. So they want to get a little extra yield, but not do more of the due diligence. And I have a problem with guaranteeing rich people higher rates of return without doing their proper due diligence on risk or taking the risk, right? There should be one instrument with government safety, and that's the U.S. Treasury note. And if you want to invest in anything else, the more money you have, the more risk of your money you should put at stake. Government is there to protect ordinary people, not to protect billionaires. But the billionaires will want that protection, and there'll be all sorts of ruses that they do. I used to have a file when I worked at Treasury in the TARP program called TARP for Me. And it was all these people that came through my door with sob stories about why it was so important. And if we were giving this money to the banks, we should give it to them because they deserve it. And invariably, they deserved it because they'd made an investment that went south, and they felt, they didn't think that investment would turn south. They misjudged the risk. And I like to say, I'm sorry. You misjudged the risk. That's on you, not on me.
Well, and I think you just kind of answered your question about the incentives for folks maybe like Barney Frank, not maybe specifically him, but the revolving door question. It's that they're misjudging the risks and they're using their previous influence, writing a massive piece of legislation to go in and then advocate for deregulatory and changes in policy that allow them to take more risk and profit more on the assumption that they're still not going to fail.
Right, but therein lies the question, if they fail, who bears the cost? I have no problem with banks taking risk and different banks taking different risks. I have a bigger problem if we tried as a goal to say no bank shall ever fail again. So we should have the same 4,792 banks exist in perpetuity, and they should have a license to make profit for their executives, right? I heard that Signature Banks or Silicon Valley Bank, I forget which one, their CEO made 1.5% of the entire bank's profits went to his executive compensation. Forget about the shareholders, right? So we're just going to have these entities and they're just licenses to print money with the federal government insuring their deposits so depositors don't put in any situation and they can't run risk. So, part of the concern here is folks could have, handled the situation differently. And it's not a one-off here. It's not just Silicon Valley Bank. You go back to the COVID crisis and the Federal Reserve and the Trump Treasury Department were handing out bailouts like it was candy at Halloween. And this has real permanent consequences. No one saw COVID coming, right? Silicon Valley Bank, everybody should have seen coming. It makes it even more important that those losses get put on the people who are asleep at the switch, who had money at risk. But in COVID, okay, no one saw it coming. But does that mean, why did the Federal Reserve bail out junk bondholders? Why didn't they lose money in COVID? People lost jobs. People went hungry, right? You see the statistics on childhood hunger during COVID? It was pretty gross and disgusting. But corporate bondholders, we need to make sure they're made whole. Why?
I agree with you on that one. Before we get into maybe some of the Trump deregulation talk and the last talk of causes, I really do want to focus in on small, medium-sized banks, regional banks. I think it was today, at least today an article was printed saying that according to Fed data highlighted by Moody's, large banks gained $120 billion in deposits. Small banks lost $109 billion in deposits, and deposits at foreign banks dropped by $65 billion in mid-March, all figures US dollars. What does this mean for small and mid-sized banks? Can their more concierge approach for small and mid-sized businesses be enough to keep them alive? Or are we witnessing a fundamental shift of our banking system into more too big to fail banks and away from Senator Langford's banks in Oklahoma?
I think it's a little early to do that. Keep in mind, Silicon Valley Bank and Signature Bank had rapid asset growth, which meant that they were very small before, right? So they grew very large and too quickly, perhaps. But again, to the extent that small banks become big and big banks become small and banks fail and new banks come up, that's a sign of a healthy society, not necessarily, cause of alarm. At the same time, the minimum size of banking has for a long time been going up based on technology, right? I bank at a very large bank and a very small credit union. I can tell you which one of their apps is better, or I can tell you which one of them has a better online experience, right? There are, fundamental factors in economies at scale that have nothing to do with this crisis and nothing to do with these situations. But there is a concern when government seems to treat larger institutions better or worse than smaller institutions. And there's also a question about kind of what's different now. What you didn't mention was the money that's flown into money market mutual funds, entities that are not supposed to be backed by taxpayer dollars at all, yet were bailed out during COVID, were bailed out in the '08 crisis. And so you see corporate treasurers moving also in that direction. And so, I think the issue is it's a little early stage to kind of draw deeper conclusions on that. One thing I'll note is the trend towards bank consolidation has been growing for a very long time. But at the same time, there have been massive growth in some of these credit unions, which may be its own set of causes and problems. We can debate if some of them really are just operating like banks. I think what we want to think about is more the dynamism in the industry and not just focus on one or two slices of it.
Do we need small, mid-size, and regional banks? Are they necessary in our system?
Yeah.
Okay, why?
They're not necessary in the sense that like France exists and it only has 6 banks, but they're beneficial. We want them. And I'll tell you why. So, I've been talking a little bit about the structure and the economy of banking, but think about the power of computing for a second, right? The power of computing allows you to get credit underwritten in tenths of seconds for a very standard box. So draw a little box in your mind, and if you're in that credit box, the world's like super awesome, super fast, and super cheap. You get credit on your phone, you get things in the mail all the time, click, 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 whatever you want, whatever you need. That's been driven by technology, economies of scale. And bigger institutions have some comparative advantage in doing that for precisely the same reasons of technologies and economies of scale. But what if you're on the margins of that credit box? You're just not quite right in that. And you need a little bit of a personal touch, right? Your FICO isn't quite right, or the product and the type of credit you need isn't in this giant mass market, that's available to 10 million other people simultaneously. The smaller institutions have a comparative advantage in that. They understand their communities a little bit better. They're a little more integrated in that. They know some of the people's histories and can kind of explain what's going on, etc. And they can provide incredibly valuable services to those types of folk. And that can create a dynamism in our economy that's incredibly beneficial. One of the ironies of what happened in Silicon Valley Bank is, under the guise of saying there were all these small companies that needed to meet payroll, again, color me a little skeptical here, right? The 10 largest depositors at the bank had $13 billion. I don't think that was about payroll, right? I don't think Roku, which doesn't even look like it was in their top 10, was going to not make payroll if they only had access to 2/3 of their money immediately and then took a 10 to 15% haircut a week or two later. But under the guise of this small business stuff, what we're doing is we're tilting the playing field of capital away from small business towards big business. When money moves out of small and community banks and into money market mutual funds, which predominantly invest in something called commercial paper, which is short-term cheap funding by the largest multinational companies in the world, what you're doing is you're slowly tilting the field of access to capital away from small and towards big. And I think in the long run, that's bad for the American economy. And I think it's bad for the American society. We are a country built on an idea. We're not built on an ethnicity. We're not built on a religion. We're built on an idea. That idea has multiple pillars, right? Freedom is one of one. But one is, the ability to get rich, the ability to make it, right? That's why the second sons of gentry came. There were the Calvinists that came to New England, where you guys are from in New Hampshire. And then there were the Southerners that came to where I grew up in Maryland, and they came for different reasons. One group wanted a shining city on the hill in the name of God, right? The other group wanted to make cash and get rich, maybe go back to England or not. And, one of the reasons we have a great country is we create a dynamism where you can come in here with nothing but skill and guts, and you can have a chance to make a run for glory. And at some point, that means you need access to a loan. You need access to capital. And we have to preserve that. And I'm worried that some of the choices we're making now, and under the guise of systemic risk, often with the smokescreen of helping a small business as a front, are really reordering and restacking the deck in a way that's not true to our vision as Americans.
Aaron, you talked about our heritage and values of free enterprise in the United States. And that has often been the basis of the arguments for deregulation in many of our economic sectors, including the financial sector. And earlier in this conversation, you mentioned the deregulation of the financial sector that occurred under the last administration. And I kind of want to return to that and hear a little bit more from you about what the specific policy changes were and how they impacted and shaped the current situation.
So let me start with the last part about the specific, and then I'll kind of return to the right. In the Dodd-Frank Act, which I worked on, we set a rule that said if a bank was over $50 billion, it would be subject to enhanced prudential standards, tougher regulation. Regulation are tests and rules. Supervision is the enforcement of the rules. Two words often used interchangeably, but very different meanings. Under the rollback of Dodd-Frank that occurred in the Trump administration, that number 50 was raised to 250. However, banks between 100 and 250, which was Silicon Valley Bank, were optional. So the tougher test was still allowed, but it was optional. Guess who had the option of whether or not to employ it?
The Fed?
Yep. The Federal Reserve had the option of whether or not to apply the tougher test. They chose not to. All right. This gets to the point I made earlier that they said, oh, don't worry, these aren't systemic banks. And then when they failed, they hit the systemic button. So it turned a requirement into an option, and the Fed didn't exercise their option. So the first order is, well, should we blame the Fed for screwing up their option, or should we blame Congress for making it mandatory to optional? But that belies the more basic question. Would the advanced test have caught the problems? And that ignores an even more basic question. What about the basic test? Because they're still subject to basic tests, not advanced tests. Turns out when you dig, number one, the problem should have been obvious to the basic test. This isn't a question of whether or not they would have gotten a grade on an AP exam or the honors test. This is like they should have failed the basic test. So it was really a failure of supervision. When you look at the specifics of the advanced test, some they would have passed, some they would have failed. Some of the advanced tests were, missed these interest rate risk questions that we discussed. Some of them were focused on the wrong questions. Some of them might have caused some issues. But I do think that in the specific case of Silicon Valley Bank, it was the failure to misread the basic test, not the advanced test, that is where you ought to blame the regulator. Then you can blame them for not imposing the advanced test on an institution whose failure was then shown to be systemic. And don't believe that other people didn't see this coming. The now chair of the FDIC, Marty Gruenberg, then was a minority board member under the Trump administration, had a whole speech about how we're deluding ourselves that we think the tools that we have can handle this type of failure of a bank of this size. He made that speech at Brookings in 2019 and, wasn't listened to then, and now is bearing the consequence of the bank's failure.
Well, I have our last question for you, Aaron, and I am very cynical, especially with the makeup of this current Congress, that we are unlikely to see substantive regulations because I don't think that Kevin McCarthy can wrangle his caucus, never mind if he wants to actually do it and waste political capital, from his view, on strengthening our regulations. So feel free to correct me if I'm wrong there. But if you had a magic wand, having worked in Congress and on really substantial pieces of legislation, what would the changes you make be legislatively to, if not prevent what we saw happen, maybe strengthen our banking system as a whole?
So here, Justin, I want to sound a note of caution that Congress can fix this problem. You can't legislate judgment. You can't legislate competence, right? What happened at Silicon Valley Bank was a stunning failure of judgment and competence by the Federal Reserve. Congress can't legislate and make them better at their job. Congress can change who does that job. Congress can change the tests that are applied. But unless you want to have Congress regulate every bank, which I really think would be a giant mistake, all Congress can do is write laws, and those laws can either specify hardwire rules and tests in place, or they can provide discretion and judgment. And then you have to have the question of the person that exercises that discretion and judgment. So I think the real set of questions here has to do more with what is wrong with the discretion and judgment and competency of our financial regulators in simultaneously saying this institution wasn't too big to fail, letting the institution mismanage itself, and then when it came time for its failure, saying, oh, wait, we can't let the creditors of that institution bear the losses. We have to socialize the losses and spread the losses across society. And that's an issue where I think, you're right that we have to have a moment where there's greater political unanimity. I would point out that before Dodd-Frank, which passed with a small amount of Republican support, but almost every major banking law in the country, whether regulatory or deregulatory, usually passed with broad bipartisan support. Historically, these issues were much less polarized, like many, across the country. And so it would be nice to have a less polarized political system on a variety of factors. But I think it's wrong to ask the question, how could Congress fix that? And I think a better question to ask is what needs to be fixed within our financial regulators to have the judgment to both apply the rules better and tolerate the failure of institutions. No one wants to see their kid fall down riding a bike. But if you don't let your kid fall off the bike occasionally, they're never going to learn to ride it.
Well, thank you very much, Aaron, for joining us.
It's been a pleasure.